Jim actually met our AAPL staff while he was at the REI Expo, and is also going to be sponsoring the REI Expo in Salt Lake City coming up in August. So if you're looking for a great event to attend, that's something to look into. I'll tell you a little more about it when we get to the presentation. I'm just going to be your host. I'm Christy Bray with the American Association of Private Lenders, the Director of Marketing and Education Services. If you have any questions, my email is there, and you can always send an email over there, or also at info@aaplonline.com. To move forward just real quickly before I hand the presentation over to Jim and Rebecca is just how to interact with us today. They're going to be taking some questions for you. We'll probably answer those at the end of the presentation. However, if you have something that pops up while they're talking, go ahead and write your comments in the question box right there on your menu or your toolbar. If you have questions or you're trying to get our attention, go ahead and raise your virtual hand. There's a little hand in the blue circle there as well. Again, I just want to thank everybody for taking your time out and joining us for today's presentation. We know everybody's got a full and packed schedule, but again, we appreciate you taking the time to join us. If you could, just a quick second, I'm going to go ahead and change this presenter over to Jim and to Rebecca, and they're going to go ahead and get started for you today.
All right, thank you, Chrissy. Can you see my screen?
Yep, just popped up, Jim.
All right, and you can see my mouse moving around.
Gotcha.
All right, good, because sometimes I like to point at things. But thank you, Chrissy, and hello, AAPL and friends. We're glad to be able to share with you today something that's so simple but so powerful. It's going to change your life forever and make it better, and it's going to help your business as well. We recognize that there are so many different ways that you can go out in the business world and make a profit. You know, this particular venue, we're talking about real estate investing, and groups like AAPL that provide such great content that shows you how to be better at what you do. Well, Rebecca and I are going to show you something today that's going to allow you to take all the information you learn about your real estate investing, go out and do that, and still make those profits that you make in your real estate. And we're going to add value to your bottom line just by making a minor change in how you use your money. Now, a good friend of ours, Carlos Lara, he's an Austrian economist. He made this statement in one of his latest publications. In times of great financial uncertainty, businesses intuitively know that first you need cash to maneuver, and second, you need to be able to access that cash immediately when you need it. So in your business, we recognize that you need cash to maneuver, and how you solve that need for capital can severely affect your bottom line. You need to look for an account that keeps your money safe, secure, liquid, and guaranteed. And you've probably looked at every account out there that's known to you, and you've considered all the options. What's the best place for you to store your money? Well, we're going to show you one that you've likely never considered. But before we get there, Rebecca is going to go through some of the ways you've been taught to use your money and the effects of each. Becky, can you hear me?
I sure can. Thank you, Jim. And hello, everybody out there this afternoon. So kind of take a step back, lean back in your chair, and think about how you pay for the things that you need or want, whether it is hard money lending to someone so that they can purchase a piece of real estate or flip a house, to the person on the other side of the coin who is a borrower looking for money, to everyday items that you purchase, cars, sofas, washing machines, anything, any way that you use money. There are basically three types of people. Now, you may only be familiar with two types of people, the debtor and the saver. So Jim and I are going to introduce to you today a third way of thinking about how you use money, which is a wealth creator. So first, a debtor. Debtors work to spend. They pay interest to someone else. like their Visa card or a mortgage or a car payment. So they borrow money from someone else or some financial entity, and they pay interest to someone else. Now, raise your hand if you're a debtor, because I have my hand raised. On a piece of commercial real estate, I owe the bank a portion of that, okay? Now, debtors, they borrow money and they don't have much leverage to ask for low market rates. And if you notice the visual at the bottom of the page, a debtor doesn't have any money. They borrow money, pay back with interest. Hopefully, you pay back that debt before you have to borrow money for the next thing that you need or want. You borrow money again, you pay it back at interest. You borrow money again and you pay it back at interest. Now, the one thing that I want you to observe here, the debtor ends up at the zero line. That's the only way that they can function. Okay, so that's the best place that they can ever hope to get to, is to pay off that debt before they need to borrow money for the next debt. Now, that is true whether you're borrowing money for a flip or a piece of rental property, a car, your own personal home, it doesn't matter. Now, let's talk about a saver. A saver, well, first of all, we'll talk with the problems about borrowing money. Sorry about that. If you're borrowing money, whether it's from a hard money lender or from Wells Fargo or Bank of America or from your mom and dad, doesn't matter. You have credit limits. So that limits you as to how much money you can borrow. Now, you may have structured principal and interest payments. If you're a hard money lender, that could cause problems if the money that you have loaned to someone, if they can't pay you back under the structured principal and interest agreement, or if you're the borrower and you have borrowed money from someone, what if you don't get the house sold fast enough, or your renter doesn't pay you so that you can pay your loan? And then you have the issue of interest, which is an opportunity cost. Let's define opportunity cost. Opportunity cost is money that you can never recapture. It's money you're giving to someone else that you can't ever recapture. That's the cost of doing business. So part of the problems with borrowing money is interest at opportunity cost. You may have structured principal and interest payments that you have to adhere to, but maybe the money's not flowing to you to be able to do that, and you have credit limits. Jim, you want to go to the next slide? Thanks. Now, let's talk about a saver. So we have the debtor, we have the saver. Now, savers, they think about money in a little bit of a different way, because they're not going to spend money unless they have it. They're not going to buy the things that they need or want, whether it's real estate, new cars, whatever it is, unless they first save the money. They're earning interest on that money. When they have enough to buy the things they need or want, then they pay cash. Now, when you think about it, savers are actually borrowing money from themselves. They reduce their collateral position. If you saved $100,000 and then you spent it on a piece of real estate, you have no collateral anymore, do you? The money's gone. And we're going to look at something called compound interest, and we're going to look at how we reset compound interest over and over again if we're a saver. So here's a visual of a saver. A saver saves money, earns interest until they have enough for the things they need or want. They deplete that account. They go to the zero line again, and then they start earning interest and saving money again for the next thing that they need or want. They pay cash, and they start the cycle over again. Now, if you notice, The saver ends up at the same zero line the debtor does, right? There's really no difference whether you're a debtor or a saver. And you're constantly resetting your compounding of your money. So let's go look at the next screen and think about, well, if you're a saver, where do you keep your money? You might keep it in a savings account, a checking account, a money market account. You may be like a lot of people and use a self-directed IRA, because then you get to control those monies in your IRA. You may put it in a safe or your shoebox or buried in the backyard. You might put it in a CD. These are all places that people put money so that they can have access to the money and use the money. So let's look at the pros and cons. If we have a savings type investment, whether it's a CD, a self-directed IRA, or a money market account, the pros is that it's safe money. We have liquidity of the money. It's comfortable because we understand those types of financial vehicles, and there could be some tax advantages, like a self-directed IRA. But there are also cons to this. Typically, these types of financial vehicles have low interest rates. You may have third-party administrator fees in the example of a self-directed IRA. You may have tax on the growth, which erodes your profitability. A lot of these types of financial vehicles that hold your money for you are subject to tax law. Well, we know that tax law changes all the time, doesn't it? So you may be subject to an adverse tax law. You know, but the most important con in this is that your money is only doing one thing for you. It's a single duty account. And we want to show you an alternative that does double duty with your money. Now, let's look at the true cost of paying cash. Because today, what we're going to do is show you not only a different alternative in the way that you use the money, but maybe shake up some paradigms as to how your money actually works for you. So here's an example. If you put $10,000 a year into an account that you're going to use to invest or save, doesn't matter, and let's say you're getting 6% on that account. It can be a money market account, it can be stock account, it can be anything earning 6%. We're going to look at a 25-year timeline. If you never touch that $10,000, earning 6% over 25 years, and you just let your money compound, you would have $591,564 in that account. Now, what if you took the money out 4 times? We drained the account 4 times so that you could lend money to somebody, or you paid cash for pieces of real estate. Doesn't matter what you're using it for. And let's say you paid back that money over a 3-year period of time. So you stopped the compounding of the money, as you see in the chart, in the spreadsheet. You put the money back, and you used it again 4 times. Because you broke the cycle of compound interest, it cost you $381,000. You could have had $591,000. The difference is $381,000. Now, why? Because you continually reset the compound interest curve. And once you pay cash, guys, for the things that you need or want, that's loss of capital. That is you giving your capital to someone else, and it's gone forever. Now, yes, the commercial or the residential properties that you buy may be appreciating, but that's a different issue. Your physical loss of money is gone. Okay. Let's look then at a wealth creator. A wealth creator thinks about money in a totally different way. Now remember, a debtor borrows money from someone else and pays them interest, or the saver saves up money, earns interest on that money, and then pays cash for the things they need or want. Remember what we saw. Both the debtor and the saver end up at the same line, end up at zero. A wealth creator thinks about money in a totally different way. So they save money, and they utilize what Albert Einstein called the eighth wonder of the world, compound interest, an ever-increasing pool of money that is compounding. And what do they do with that compounding account? They go borrow other people's money, use their account as collateral, so they get to borrow from a lender at negotiated rates because they have collateral, right? By using their money as collateral, we have an uninterrupted earnings potential in your own personal account. So let's look at the visual. So you have a compounding account as indicated by the green line, the green dotted line. We never spend our own money. Now we're thinking like the Donald Trumps and the Bill Gates and the Warren Buffetts of the world, the Sam Waltons. We never spend our own money. We use our money as collateral. We borrow at negotiated rates because we have leverage now, right? We have capital. We have collateral. We pay back our chosen lenders, and as we pay back our chosen lenders, our own money that is still compounding grows and grows and grows. Totally different way of thinking about money. So Jim, what about the next screen?
So the next screen we want to talk about how do we become a wealth creator? All right, and Becky's done a good job of illustrating what a wealth creator looks like, but in order to become a wealth creator, in order to be able to do this, you're going to need the right asset to work from. All right, and as Becky's illustrated, one of the key components there is the compound interest curve. You're going to need to have it in an account that you can continue to earn interest on the money even while you're using it. So additionally, you're going to also need to have collateralization capabilities. But as we're designing this account, what else would be some really cool or some really neat attributes that we could have included in an account if we could design it from scratch? Now let's take a look at these, and you can go ahead and chat if you see any of these that you don't like. But a high rate of return consistently, tax-free growth, tax-free distribution, no fees. How about no third-party administration and no government rules on how you use the money? No penalties for using the money. It's easy access. Multiple duty. We talked about the single duty earlier, where your money's either in the account earning interest or it's in your business going to work for you. What if it could be in both places at the same time? What if the values were guaranteed? There was a no loss provision. The money would never go down or lose value. It would only go up. You were in complete control of the money. The money grew with a hedge on inflation. It had a credible reputation with a measurable history of success. You're able to complete your transactions in complete privacy. The money would be creditor proof. And what if you could use this money at any age without penalty? We hear so much these days about, some of the qualified plans and required minimum distributions and when you can get to the money and when you can't get to the money. Well, what if you had complete control of those things? Imagine having this account with these qualities and having full control of the asset. Wouldn't it be great? Well, that's what we're here to talk about today, is an account with all these qualities. It's been around for over 200 years. In fact, your parents and your grandparents used this account primarily for their savings and retirement vehicles. But as you know, as the story goes in our culture, if something is working really, really good, we try to go out and improve it. And that's exactly what happened here. So let's take you back to an account that we like to call the AND asset. The account that allows you to put your money into a high interest earning environment, but can still be collateralized, and you can put the money to work in your business so you can maneuver like you need to, like you want to. The product we're talking about is permanent life insurance. Permanent life insurance has every one of those qualities that we listed before. And I can't think of one of these that are bad. Okay, so how do we use permanent life insurance then to become a wealth creator? Well, first we want to look at how banks make money. Have any of you ever seen the calculators of how banks make money? It's really pretty interesting. So let's just make some assumptions, and let's go back to maybe the 1980s. And I'm using these values for a reason, I'll tell you later. But let's say the bank pays you 6% interest on your deposit. And if you need to borrow money from the bank, you're probably going to have to pay 15% to borrow the money. It sounds a lot like the 1980s. What's that look like? Most folks see that and they say, well, the bank is getting 6% on deposit to the depositors, but they're paying getting paid 15% on loans. It sounds like about 9%, right? But it's really 150%. And why is that? Well, the bank's initial investment, if we used $100 deposit, the initial investment on that is $6. So if you put your money in the bank, they would pay you $6 at the end of the year, simple interest, to keep your money there. If I needed to borrow that $100, the bank's going to, first of all, they're going to loan me your $100 that you deposited. And they're going to charge me $15 after that year to keep it there. So they made $9 on a $6 investment. That's 150%. Okay. If they use their own money, if they loaned me their money at 15%, they only make 15%, right? So they figured out the importance of leverage. They figured out the importance of using other people's money, okay? And that's what we're about to show you here. Let's look at how life insurance works contractually. Okay, first of all, you put money into the insurance company, and the insurance company in return guarantees you a certain death benefit. We all understand that about life insurance. But that's normally where we stop in our understanding of the policy. When you look deeper into a whole life insurance policy, it also builds a cash value. And that cash value has two internal growth components. There's a guaranteed interest rate, and right now it's 4%. But because we're using mutual insurance companies as opposed to stock companies, the mutual insurance company at the end of each year is going to pay back the divisible surplus to the policyholders in the form of a dividend. So we've got two internal growth components that are growing tax-free. You're not going to get a 1099 on this money every year. It's growing tax-free. And in the insurance contract, there's more language in there about the loan provision than there is about the death benefit. They're both very important, but we're here to talk today about the loan provision. So how does it work? You put the money in, you watch it grow, and when you need to go out and solve your need for capital that we talked about before, you simply call the insurance company, ask them to borrow the money. They'll take a lien, a collateralized lien against your cash value, and they'll loan you their money at interest only. Now, that's important because we just talked about how banks make money. The insurance company is going to loan you their money. They're not going to take your money out of the account. So you've just collateralized and used other people's money to go do your business. Meanwhile, your entire cash value, even the collateralized amount, continues to grow with those two internal growth components. Now they're charging interest, and let's say right now they're charging 5% interest to use their money. Do you think you could go out and borrow someone else's money at 5%, put it to work in your business and make 15 or 20 or 30% and put it back? Sounds an awful lot like how banks make money. Now, Rebecca talked about the non-structured payment, and that's a really key factor there. What's non-structured mean? Well, there's no structure. You get to pay that back when you want to, how you're able to. And that's an enormous benefit when we're dealing with other people's money, especially with real estate investing. Okay. Rinse and repeat. You put the money back in. As you pay the money back, your collateral position is reduced, and you're able to borrow that same money again and do it all over. Okay. So next, Becky's going to look at with you a real life example of how this might look, this process might look compared to the debtor, the saver, and now the wealth creator. She's going to look at some calculators. Becky?
Okay. So any account, we're going to compare three options. Let's first pay cash. So if you have a cash account that has $30,000 in it, and you were going to take $30,000 and make a down payment on a house, or buy a $30,000 house as a rental property or whatever, you can use this, think about a $30,000 car. You can use for anything. So I don't want to just limit it to real estate, okay? And let's say that that $30,000 was sitting in an account earning 2.5% interest. Now we're going to measure these three options over a 5-year period of time. So you handed your cash to someone else. Let's say you got a great deal on a piece of property, $30,000. Because you lost the availability of earning 2.5% interest over that 5-year period of time, the actual cost of this transaction was not $30,000. It was $33,390, because you not only gave the principal away, which is no longer working for you, but you lost the 2.5% interest. So $33,390 was the cost of this transaction, whether you were buying a car or buying a piece of property. Now, the next option would be to finance that $30,000. If you borrowed $30,000 from some financial institution and they charged you 6% to borrow that money, they get to determine over that 5-year period of time how much they want you to pay them, $577.10 a month. And you don't have a choice. You have to pay them, or they'll come get your asset that you collateralized. Now, for 5 years at $577.10 a month, the cost of this transaction, if we were going to use someone else's money, a financial institution's money, that transaction cost you $34,126. So whether you pay cash or you finance, there is a cost to the money. There's a cost in the lost interest if you pay cash, or the interest you have to pay someone else in the form of financing. Now, the third option, thinking like a wealth creator, we're going to take a loan from our traditional whole life policy And remember, it's a guaranteed loan. If you have collateral in cash value, the insurance company guarantees they'll give you the loan. Now, if they give you a loan at 6%, do you have to pay them back $577.10 a month? No. Remember, Jim said that you have control over how and when you pay that loan back, right? But to keep everything even and to have a really good look at these three options, I'm going to assume that you pay back to the insurance company exactly like you would have paid back to the finance company. And if you did, you would still have a cost of $34,626. So, if you go to the next screen, Jim, let's look at all of these options. Remember, if you're a wealth creator, your money is still in your account. Your $30,000 is still in your cash value account. And if you're earning 5% on that money, which I'm earning at least 5%, over that 60-month period of time, 5-year period of time, your cash value has increased to $38,501. Now, it cost you $34,626, didn't it? So if you pay cash, the cost of taking that cash and using it and not earning interest on it, in this example, was $33,390. And how much money do you have left? Nothing. If you financed it, the cost to borrow from someone else, in this example, was $34,626. And you have nothing left either, because otherwise you would have paid cash for it. And if those are the only two options you knew, you would always want to pay cash, because that's the cheaper way to finance the things you need and want. However, if you look at the private reserve strategy using whole life insurance, the cost was still $34,626. But we still have $38,501 in our cash value account at the end of 60 months. And can we not take that money and borrow against it again and again and again and again as it continues to compound? But see, we have no money left in our cash account. We have no money left in our finance account. So, Jim, I think you're going to give an example of this.
We are going to give an example of this, and I've got to set this up now. I'm going to compare two private money loans. We've got property A and property B. Now, why did I pick this particular case? It's actually one that I'm working on with a client currently, and he came to me, heard us speak, he heard Rebecca and I speak, and was interested in what we had to say, and he said to me, Jim, work through this with me. Let's see what this would look like. And the case setup is something like this. The gentleman owns a couple of real estate properties that he has as rentals, and they're cash flowing him net annually about $10,000 a year. And his whole idea was that he wanted to reinvest that money back into his real estate business, and he expressed an interest in private money lending. So we wanted to take a look at two options. What if he ran the $10,000 back through a cash account, or what we've been referring to as an OR account, compared to what if he ran the $10,000 back through a permanent life insurance policy? So that's what we're going to look at here now. Is a couple of assumptions that we've set up here. Property A is going to be a loan source of cash, and we're just going to say that he's earning 0% on that cash. Property B, he's going to use the whole life insurance policy, the loan provision for the money, and internally with the application or the illustration that we did on his case, the internal rate of return is 4.97%. The policy loan rate from the insurance company is set at 5%. A few other things. It's an interest-only loan. He's going to earn 12% annual simple interest on that, which equals $100 a month, and he's in about a 30% tax bracket. So he's going to take the $10,000 a year that he's cash flowing from his rental properties. He's going to put it in the account, property A or property B. We're going to take he's going to make his first private lending loan in year 2 because he's earning this money monthly. So by the end of year 1, beginning of year 2, he'll be able to make his first loan. He's going to loan $10,000 each year, repaid each year in 12 months. And we're going to look at this over the next 25 years. Okay? So that equals 24 loans total. Loan A on cash, he's going to put $10,000 in the account, loan $10,000 a year, cash flow $1,200 a year. His future value would be, $250,000 has gone into the account. His cash flow has grown it by another $28,800 for a total of $278,800. Now, where do I get all these numbers? And I'm going to break my own rule here, and I'm going to pull over a live calculator on a live webinar. So cross your fingers. So here's a really cool calculator. Is 25-year period, $10,000 a year going into the account. He's not earning any interest, and he's not paying any taxes because he's not earning any interest. So $10,000 goes in. That's easy. It adds up to $250,000, and then we apply the loan, $10,000 at 12%. You can see 278.8. All right, so we'll pull that back out of the way. Let's look at property B. $10,000 a year going into the insurance company. He's going to loan $10,000 a year. The loan interest due to the insurance company would be $500 a year. So his net cash flow is $700 annually. Now, in 25 years, his $10,000 deposits into the insurance company would have grown to $498,000. His cash flow in that 25-year period is $16,008 for a total of $515,710. Okay, and if I can go back a screen, that's a little bit more than $278,800. Right, now again, where did I get those numbers? Same calculator, different screen. But what I want to show you next is what if he took his cash flow every year and reinvested that back into the permanent life insurance? Well, there's his $498,910. Now his cash flow grew to $32,968 for a total of $531,896. Well, where did I get that? Let's pull this over. I'm breaking my own rule again. So there goes his $10,000 a year, 25 years into the insurance policy. There's the cash value building. $498,910 would be the policy if he didn't do anything with it. Now he's going to loan out $10,000 a year at 12%, and we're going to reinvest that back into the insurance policy, and it grows to $531,896. Now, we just showed $10,000 a year for simplicity, but one of the things we're working with is, well, now he's got this ever-increasing cash value in his policy. What if he increased his loan amount every year by 10%? Well, now the thing grows to $605,000. Maybe we can push it up to 20. $942,000 now by recycling that money back through the insurance policy, allowing the cash value to continue to grow while he uses the money. Now he's got $942,000 at the end of the period. All right, let's go back to zero. 531 is where we ended up in our calculation. So here's the summary. The same $10,000 went into each account. Property A, he ended up with $278,000. Property B, he ended up with $531,000. That's pretty substantial. It's 90% more money at the end of the day. His money's been growing at 5% tax-free for the entire period. He's got increased asset protection. All right, this money is creditor proof. It's all been done in privacy. This money, these loans aren't reported to the credit bureau. Nobody knows he's even got these loans outstanding. He's got the death benefit protection, and his money's been able to work in more than one place at a time. Now, who wants to be a wealth creator? Let's go back and count all the places that the money's been put to work. Okay, first, we've got the death benefit. That's the life insurance portion. So that's one. We're getting a guaranteed interest rate on the cash value. That's two. A dividend. That's three. We've been able to go out and use the money and make money like the banks do. That's four. And Rebecca's going to show you one more. By using this money and using it through his LLC, we're able to take a look at some tax advantages that may be available. So Becky, you want to walk them through this?
Okay, Jim, can you hear me?
I can, yes.
Okay, great. Because I lost you for a minute.
Well, I hope everyone else didn't. Christy, were you able to hear me the whole time?
Yeah, you guys are doing great.
All right, super.
Okay.
Thanks.
Thank you. So let's talk about then another advantage to doing business this alternative way, being a wealth creator. Let's talk about how a bank makes money. Now remember, this is just a review. You have money in a checking account, a savings account, a money market account, a CD at the bank, doesn't matter where. Now, the bank is going to take your money and they're going to loan it to some borrower. Remember, a bank never uses their money. Now, the borrower is going to pay back the money to the bank with interest, and the bank is going to give you a tiny little bit of that interest as a thank you for being able to use their money. Let's look at this process with the banking idea in mind. We're going to change the players in the game, guys. Instead of putting your money in a CD or money market account, you're going to put it in an insurance policy. You are now the bank. And your company, your real estate company, is the borrower. You borrow from the insurance company money at 6%, and you're going to loan it to your company at 12%. The company is going to pay back the loan to you, and you're going to pay back the loan to the insurance policy. Now, doesn't that look just like how a bank makes money? Let's go see the advantages of using it this way. So, thank you, Jim. Now, if we take, you know, that $30,000 that we were talking about, that loan, when I was giving you the first example. So here is an insurance policy, and if we borrow, if the family borrows $30,000 from the insurance policy, you loan it to your S Corp or your LLC, and they're going to pay you back. If you did not use this, if you just paid cash, in this example, you would have $3,600 of income you would have to pay $1,000 at a 30% bracket. You'd have to pay $1,080 in tax. So you would have net to spend $2,520. But just by using the process alone, just the process, when your LLC or your S Corp paid you back the $3,600, your K1 is reduced by $3,600. Your taxes were reduced on the corporate level by $1,080. Now, that switched over to your personal tax return. You have to show on Schedule B that $3,600 as investment income. So your taxes increased by $1,080 on your personal tax return. That's a total wash. Your taxes reduced in your corporate return by $1,080. It increased by $1,080 in your personal return, and that is a wash. However, the interest that you have to pay to the insurance company, the $1,800, you get to write that off on Schedule A as interest expense, creating an additional tax reduction of $540. So let's recap. It's all about the money you get to spend, right? Or keep. If you did not use this process of running money through a life insurance policy, you would be able to spend $2,520. However, by using this process, you saved $540 tax. You got the whole $3,600 back in your pocket for a total of $4,140 to spend. Now, this is just a simple, small example, but you start adding zeros to the back of these numbers, and then it gets real interesting. Jim, can you go to the next screen?
Sure can. So we always like to end with this question. If what you thought to be true about money turned out not to be true, when would you want to know? And the answer, that's pretty simple. You know, the answer is now, right? And we're here to help you learn more about this. And I can't tell you how very, very simple this is. So many things that, you know, we run into these days seem to be becoming more and more and more complicated. And I hear from folks all the time, I just don't have time to learn something new. Guys, this is as simple as just changing the direction of the money that you're already using. Where are you going to put it? And Rebecca and I can help you set that up and help show you how to use it. And I'm here to tell you it's going to change your life, and it's going to be so simple to use. Feel free, contact us. Here's our contact information. We'll leave that up. And we're going to open it up now for some questions. Chrissy, you've been collecting questions up until this point. If you have any, Rebecca and I are ready to answer some questions.
Yeah, right now nobody has sent anything in, so guys, this is the time. If you have questions to ask about today's presentation, go ahead and do that, putting it in the text box that we showed you earlier, or just raise your hand and we'll call out for you. Okay, we've got a couple in here. So you said no penalty for an early withdrawal.
Jim, you want to answer that one?
Absolutely. Yes, absolutely. You know, when we talk about that, we're comparing that to traditional qualified plans where you put money into these accounts and it grows, maybe tax deferred basis or tax free basis, and there's rules. you cannot get to that money until age 59 and a half, and then you have to start taking a certain amount out, or you're going to have penalties. But if you need to get to that money before age 59 and a half, there are penalties involved in that. And what we're saying with the life insurance product is there are no penalties to borrow the money, to take the money out if you decide you need to take the money out, and you can do that at any age. So no, there are no penalties for use or distribution of the money.
Great. That's great for now. All right, well, we are coming up with about 5 minutes left before we end the session today. So if you have any other questions, go ahead and send those in right now. I'm going to jump ahead and try to hit the next 2 slides before we stop today's presentation. So again, if you grab Jim and Rebecca's contact information, it's available here, or you can always contact us here at AAPL and we can get that for you. As always, we would like to let you know what else we have going on this month training. For those of you who have participated in our training in the past, you know we generally hold about 2 webinars a month. We're looking at 3 for the month of August. Very busy August. Join me. It's going to be me, Chrissy. Next week, August 5th, we're going to talk about your influencers in customer service and how to connect with those through social media. So whether or not you're just starting, maybe you haven't started at all and you've got some interest, or you've been doing it for quite a while, please join us. It'll be a quick presentation, 30 to 45 minutes or so. Then on August 12th, we're going to do an online workshop. Now this is actually an AAPL exclusive that's going to be run by the Finance Institute and Mike Panamero. I always want to say Palomalo, being a big Steelers fan. If he knew that, he probably slapped my wrist. But then going on to the last one for the month of August is compliance update, what to expect in the ever-changing environment of the. And this is the 3rd part in the series from Weltman, Weinberg, and Reese. And that'll be Wednesday, August 19th. So again, you'll see the emails coming through. If you haven't signed up for the Friends of AAPL, again, just shoot an email over to us and we'll get you connected in that way, or find us on Facebook and Twitter and all social networks that are available. And for those who did attend today, we do have an offer available to you. We usually do our offers for about a week, but because we are backing up our webinars from week to week, we are extending the deadline for these offers. So if you haven't joined AAPL yet, and I don't know why you haven't, then you can get 25% off any level of your membership. So that would make your $400 individual membership to $300. But again, you got to call us or email us by Wednesday, August 12th. And for the members out there, we have $50 off your professional training center. So we're getting to that point of the year that if you have one of the designations and you need to maintain it, this is the way to do it. Time is ticking. And then if it's time to renew for you, 25% off. And again, let us know by August 12th. Now, I think I saw one more question pop in, and since I'm such a fast reader, I think we can get that through before the 4 o'clock mark. So let me go grab that. Okay, here it is. I have a question about what about surrender charges?
Becky, you want to handle that one?
Yeah, I'll answer that. There are no surrender charges. The money in your cash value, remember, you own it, you control it, it is totally yours. You get to use it as you choose. So there are no surrender charges in it.
Okay. And it looks like maybe one more. I just lost my taskbar. Hang on a second. Okay, so last question for today. And just a reminder to everybody, if you do have any additional questions, go ahead and reach out to Jim or Rebecca, or even send them here to AAPL, and we'll reach out to them for you and get those responded to. So last one. So this is not for the self-directed IRA, but use of a life policy with a cash value?
Yes, that's right. Now, remember, this is not a typical life insurance policy that maybe you guys on the call today are used to seeing. It's a very specifically designed policy that has very low death benefit and very high cash. We can't use it for as a self-directed IRA because life insurance is tax-free money. So we can't commingle monies that you've already had a tax deduction on, deferral on, with monies that are going to be tax-free. So it's something totally different than a self-directed IRA.
Okay. Well, guys, that's our 4 o'clock mark. We made a full hour today with some great information. So thank you so much, Jim and Rebecca. It was fantastic to be able to work with you.
Thank you.
All right, everybody else, you have Jim Rebecca's contact information. And again, anything that you need from AAPL, you can shoot us an email at info@aaplonline.com. And as always, we really appreciate you taking time out of your day to join us. Hopefully we'll see you again soon. Everybody have a great rest of your day. Thank you. Bye-bye.